Ladies and gentlemen, welcome to a new episode of the FinTech Hunting Podcast. We have an incredible guest for you today. He is a frequent contributor. He's a tech innovator, an industry thought leader, AI evangelist. Please help me welcome back to the show, Tim Nguyen, founder and CEO of BeSmartee. Tim, welcome back.
Michael, good to see you, sir. Hope things are well.
Things are well. It is great to see you. I want to dive right in because you always have so many great insights. I was just reading an article off of MBA Newslink that you wrote called Application Abandonment, the Silent Killer of Mortgage Profits. Talk to me a little bit about that. I know one thing you mentioned in there is mortgages as a camel business. Unpack that for me. What do you mean by that? And we'll kind of dive into the whole article.
Yeah, so the camel idea I got from my CFO at BeSmartee, and I dug into learning more about camels. And as we all know, right, they hoard a lot of water. They survive the harsh, brutal desert until they can find another pool of water, and then they suck it all up, right? And we hear in our industry all the time, fast or famine, and it just resonated with me. We are literally in a camel business. It's a business strategy term. And if we recognize that we're in a camel business, that tells us what we need to do through the good times, the bad times, everything in between. So that's really kind of the idea there is we are in the camel business. Right now, things are starting to look up. We'll see what happens with the interest rates as it continues. Demand's coming back. People are excited. Profitability is coming back. Lots of positive things happening. NBA gave about a 12% increase in originations next year and into 2027 as well. All good signs that there's water coming. It's been a dry, brutal desert, but almost 3 years of that ever since Ukraine in March of 2022, I think it was. And we're all thirsty, and let's get to work and drink up a lot of water as it comes, because we are literally camels walking through the desert in this mortgage space.
I love it. What a great analogy. And now I have a perfect visual. And it is so true. It is feast or famine in this industry. And when you look at it that way, your business strategies, how you approach things can be much more intentional and on point. In the article, you go on to talk about it, and most people obsess over application to submission and submission to funding. But why is application start to application submission ratio so overlooked?
Let's talk about what it is for a second, right? What I'm talking about, right? So most lenders that we survey will measure from application to submission, right? Submission to wherever it needs to go, whether locked, unlocked, beginning of the month pipeline, whatever. And that makes a lot of sense. I mean, you have to look at that, right? But what we're missing out on is what leads into application, right? Yep. And what we found is when you send someone to an online portal, 100 people, for instance, not all 100 people will provide an application.
That's right.
So let's say it's 65 people that provide an application. That means you have 35 that you have to chase down, re-engage. And if you're successful to re-engage, things are good. However, you still spend a lot of time getting them re-engaged. If they had just converted nicely in the beginning, you wouldn't have to do that extra work. Let's say you're at 85% conversion. That's an extra 20 applications that start the application to submission, application or submission to funding ratios. So it literally is the tip of the spear that's so often overlooked. And you ask a great question, why? I've been scratching my head about this one. I'll be honest. If you're running an e-commerce company, you will be measuring shopping cart abandonment. That's probably going to be your number one metric. Above fulfillment, above website traffic. Someone puts something in the cart, do they finish that process and transact the deal? So it's very similar to the e-commerce space, right? And for us, I have a thesis, and I'd love to hear from the audience. Ping me, tim@besmartee.com. Let me know what your thoughts are, but I kind of bucket it into a few different areas. Number one, none of the point of sales out there today, other than ours, I would say, actually make this transparent. Is that easy to get this data?
Right.
All right. And so that's the first thing. The second thing is, I think there's a mentality of, hey, getting the application is the loan officer's job. How they get it, what their success is, as that's on them. As soon as they get an application, I'll measure the rate at which they submit to the pipeline. And once it's in the pipeline, I'll measure what the ratios are for locked and unlocked loans to funding and closing. So I think it's just maybe the way people look at the origination process. Now, if you look at consumer direct, the corporations buying all the leads, you are pretty sure they're probably going to be measuring that, right? But in more retail environment, well, it's the originator's job. I'm not going to get in the way of the way they do business. However, I don't propose you get in the way. I propose you simply give them better tools and educate them how important it is, right?
Well, and you mentioned even in the article what a 10% improvement in that, what that would do and what kind of lift it would give the lender. Can you provide a little more detail on that?
Yeah. So a 10%. So this math is based on a couple assumptions. Okay. Let's just assume you have 10,000 application starts, not finishes, but starts every year. 9,000 gross revenue per funded loan is about 225 basis points, right? Based on the average loan amount. Application to submission ratio, right, of 25%. So your loan officers get 100 applications, 25% get submitted. Especially in retail, right, you have a lot of pre-quals and pre-approvals, right? So the ratios are low. Submission to funding, once it actually gets in the submission pipeline, is 55%. Based on those numbers, if your point of sale today, for example, is converting at 70%, and instead it could be converting 80%, that 10% difference equates to about 14% of top line revenue. Wow. Adding another loan, finding more borrowers, buying more leads, hiring new loan officers. So it's a multiple effect, right? Again, it's a tip of the spear. It's where the measurement needs to begin. And I just hope lenders start measuring that. If they measure that, there could be a lot of things wrong. Maybe the point of sale is just fine. Maybe it's the messaging leading into the point of sale. Right. Or the messaging inside the point of sale. Right, whatever it may be, but we got to start measuring that because the water's coming, and guess what? There's thousands of camels going to the same spot. Not gonna be enough water for everybody. So we got to get there fast, and once we're there, we got to suck up all that water as fast as we can.
As you have done this research, do you find abandonment is more of a tech problem, or is it a people process problem?
It's 3 different problems in 3 different ways.
Okay.
Let's start with technology. If, for instance, would you rather go through a 10-step application process or a 15-step application process?
10, right? Shorter, easier.
Would you rather answer 40 questions or 60 questions, right? So the design of the technology will help, okay? The automation inside the technology will help. For instance, I don't need to ask you how many stories your home is. If I can pull that from proper profile. That's just one simple example, right? So less questions, a shorter process. That's a technology design problem, right? So you got to make sure that's solid, right? If your buyers are going through, spending more than 10 to 12 minutes on an application online, your abandonment rate is probably pretty high. The best we ever saw at BeSmartee was 94%. On average, we're running about 85%. That 9% delta was during the pandemic boom. Because leads to the second factor. There's market dynamics where those consumers at that time said, gosh, 2-3% loans, I can't miss out on this. I'm making time to finish this, right? So that's why we saw that 9% increase. About 94% of all borrowers starting will finish that application process. So market events are critical. Third, people and process, absolutely. Loan officers originate some different ways. You have different pitches, you have different messages, you serve different locales. So the way you present your messages, the way you use your point of sale, for example, the way you interact, people and process lead to the next step in the process of collecting an application. It matters, right? Like I tell people all the time, originators, and this doesn't make my pocketbook any bigger, but I tell them the truth, which is you got to borrow on the line, on the phone, in person. Just take the app. Do not send them an online application. Stop. Just take the app. You have them committed. This is your chance to close the deal and take it further down this, move the pipeline forward. So I would bucket in those 3 different categories for those 3 different reasons.
You've kind of touched upon it, but I want to dive a little bit deeper. What are some of the biggest mistakes lenders are making in that application experience?
Well, it's so on one side of the fence, when it's an operationally driven decision, where processing and underwriting and ops managers are involved, it becomes a data completeness outcome. They want the point of sale to collect everything, every bit of information the tenant 3 they wanted to collect. I get the point, but you're asking the borrower to go through a longer, more complicated process. And you know what? We are in a revenue cash flow business, right? Operations is absolutely important, but it's not more important than top line revenue. We got to get those deals in, right? We got to get that borrower experience to be optimal. On the flip side, we also see the opposite, where it's more of an origination driven mandate. In those cases, they want it really, really short. Just I don't care if they finish the application, just push it to LS. I'll do the rest. Well, what the rest means is you got to pick up the phone, you got to spend another 20 minutes interviewing, which there are benefits here at building rapport and relationship with the borrower. But in this market that we're coming towards, arguably 18 36 months, who knows, right? How long is this going to last? You're going to have top of the funnel demand. You got to get that thing in. You got to use time to work the files that need your attention. Let the other files go through. This will increase your success rate or your closing rate, increase the number of loans and units you're going to close. That'll be the next data point we get into with the surveys of our customers.
I love it. You always have such great insights. If you could give one piece of advice to every lender listening, what would it be?
Oh gosh. Just start measuring your application abandonment rate. Add it to your list of metrics. You all have one. You get a daily dashboard. You probably look at it 5 times a day. If you're like me, constantly obsessed about it. Make sure it moves in real time, right? But get this new data point. If you can't get this data point easily, you really got to be concerned. Because this is when a consumer abandons, it says just a few things. Your process is complicated. I'm out. Right?
Yep.
I got distracted. How do I get back in and finish this thing? Right? So there's just a few different reasons why people abandon, right? Maybe the kids came home from school and they got to get back into it this evening. Whatever it is, just get the data, start looking at this, especially if you're consumer direct, but even if you're in retail, help your originators close another 0.75 deals a month in the coming boom. They're going to love you for it. They're going to make a lot more money. They're going to be a lot more successful. They're going to love what you've done for them. They're going to stick around. And let's not forget, when the market tanks, because it will, let's be real, right. It always happens, be ready for it, right? In this market coming up, how much water can I suck in and store away? Well, when things are really dry, even if you come across a small puddle, you want to make sure you suck it all up, right? Right. So it's good. It's important in good times and bad times.
Great insights. And now we're in the throes of conference season. Tell me, where can people see BeSmartee in action? When they find out more about all the great stuff that you're doing? Give me some of the updating conferences you guys will be at.
Yeah, absolutely. So we're going to be at Actionable.
Okay, and that's in Denver, right?
What's that?
That's in Denver, I believe.
Yes, I think it's Denver this year. And I literally just reviewed the budget. I forgot. My bad. Acma, MBA, and
Housing Wire Mortgage Banking Summit. I think they changed it. It used to be the IMB, but now they changed it to a banking summit.
We're not going to be at that one, but definitely the other 3: Housing Wire, Acma, and MBA. The annual one. Coincidentally, we're also sponsoring a show that coincides with IMN AI Summit over at Dana Point here. And if you're a BeSmartee customer or a BeSmartee prospect, or me, shoot me a text. We're holding a invite only free poker tournament, and we'll save a seat for you with cash prizes. No buy-in required. Food and drinks.
I love it. Tim, you guys are always doing creative things, but most importantly, you always share great insights that can be used and implemented. For those of you listening, if you haven't seen BeSmartee, check them out. They're doing some incredible things. Talk to Tim and his team. They've got great insights to share to help you continue to grow your business. Tim, thank you for being a guest on this episode of the FinTech Hunting Podcast.
Thank you, Michael. Have a good one.